Why do most investors fail? Buying low and selling high is the objective of both investors and speculators, but very few people are able to consistently achieve this goal. This is true even for those who make their living in the investment industry. The vast majority of mutual funds, pension funds, bank trust accounts, and investment advisors are unable to obtain the returns on their investments in common stocks that are indicated by prominent stock indexes. This is the case for both individual investors and institutional investors. According to the law of averages, some people may have a year in which they do very well, and these people frequently find themselves inundated with so much fresh money to invest that they do not know what to do with it. However, only a small percentage of investors are successful in outperforming the market over extended periods of time. Here are below reasons your portfolio could fail. 1. You don't have set expectations. Everyone needs to set expectations when they start investing. Jumping in with just the hope of making money isn't the best idea. You need to set expectations for returns, for example, so you can judge the performance of your portfolio. Having set expectations for yourself or your advisor is critical. Once those are clearly outlined, you can better understand potential risks/returns and how to set up your portfolio. Questions to consider include: what are you investing in? How often should you be trading? What are your rules around buying and selling within your portfolio? For example, what is your process so you know when to buy more or sell? What is the target rate of return/loss for your investment mix? For example, how much can you expect to gain or lose in a given market up/down scenario? 2. Purchasing shares in a company about which you have little to no knowledge. A common tendency among investors is to put their money into the newest industry or one that seems impressive. It is possible that they know very little, or even nothing, about the technology, biotech, or the particular business in which the underlying company is engaged. Of course, this does not prevent them from making an effort to board what they believe will be the subsequent train of profitable opportunities. In this case, the investor is missing out on all of the perks and advantages they would have over other investors who know less about the business in general. If you have a solid grasp of a company's operations, you will have a significant leg up on the majority of other investors. For instance, if you own a restaurant, you'll be familiar with the various companies that are active in the restaurant franchising industry. You will also get a first-hand look at the routines of the customers, giving you this information before it is known to the general public. As a corollary, you will be aware, well in advance of the vast majority of other investors, of whether the business is booming or slowing down. Taking our hypothetical situation a step further, if you pay attention to the shifts that are occurring in the market sector in which you operate, you should be able to recognize excellent chances for financial investments. It would appear that having first-hand expertise can result in profitable investments or avoiding losses. If you invest in a firm that is above your pay grade, it is possible that you will be unaware of the nuances and complexities of the company in the issue. This is not to imply that you need to be a gold miner or a medical doctor in order to invest in firms that are involved in gold mining or healthcare, but having either of those backgrounds certainly wouldn't hurt. You should make the most of any opportunity in which you have an unfair advantage over the majority of investors and push that advantage as far as you possibly can. If you are a lawyer, you may have an advantage in determining when it is appropriate to invest in companies that generate money through the litigation of other parties. If you are a surgeon, you will have a greater knowledge of how well, or poorly, a surgery robot is performing its duty, and as a result, you may have an inside track on how well the underlying stock may perform. If you are not a surgeon, however, you will not have this insight. 3. Putting at risk financial resources that you cannot afford to. It would astound you to see how drastically different your trading approach becomes when you utilize funds that you just cannot afford to lose. If you could see this, it would astound you. Your feelings become more intense, your stress level rises to new heights, and you find that you are making decisions regarding sales and purchases that you would not have typically considered under regular circumstances. According to an old proverb originating in Japan, if you gamble with any amount of money, you will inevitably end up losing all of it. This holds true regardless of how much money you wager. You should never put yourself in the high-pressure situation of putting money on the line that you need for other reasons. In other words, you should never gamble with money that you need. This is a situation that ought to be stayed away from at all costs possible. You will be able to make far more relaxed decisions regarding trading if you invest with money that you are both willing and able to lose. You will have a lot more success with your transactions in general if you do not let fear or any other bad emotions affect your trading decisions. 4. Being motivated by restless waiting. Although we may have touched on the numerous emotions that may come up when you are investing, impatience is one of the moods that might end up costing you the most money in the long run. It is vital to keep in mind that stocks are only ownership shares in a particular firm, and it is also important to keep in mind that businesses operate at a much more glacial pace than the majority of us would often like to see, or even than the majority of us would ordinarily anticipate. It may take many months, or even several years, for a new strategy that management implements to start having an influence on the business as a whole. This is because it takes time for the new method to permeate the organization. Investors have an all too common tendency to buy shares of a company's stock and then have the unreasonable expectation that those shares will immediately begin behaving in their best interest. This completely disregards the slightly more reasonable timeframe that businesses operate under. It is very likely that the changes in stock prices that you are watching for or expecting to occur will take a significantly longer period of time to take place. When customers first begin investing in shares of a firm, it is imperative that they fight the need to act in a hurried manner, both for the good of themselves and for the sake of their financial resources. 5. You followed misguided advice. Misguided advice is one of the biggest reasons people lose money and have a failing portfolio, in my experience. A friend or family member might give you advice, because that's what they heard from someone else, or because they have a feeling about a certain stock with no real due diligence into the company. Or, they are predispositioned to invest in a way they had success with in the past, but don't take into consideration their buying price and the time in which they purchased. Know what you are buying, why you are buying it, the story that hooked you, and the story to keep you invested or make you divest. Following tips is okay, but do the work when investing. If you want to give it a gamble, that's also okay. Just make sure you know when to exit. Don't be the one holding the bag as your investment goes downhill. Also, don't miss your shot to make a good profit because you don't know where the company should top out. Have an exit strategy. It takes time, discipline, and unshakable belief to avoid the various traps and accomplish the desired goals. Do not rely on internet media, brokers who try to sell you anything, or your own naive optimism for success. The vast majority of us are not very good at managing our investment portfolios, despite the fact that we are well prepared to make long-term investments. Many of us are prone to thinking in the short term, which runs counter to the long-term investing goals that we have set for ourselves. In a similar vein, we fail to develop an appropriate strategy for investing, which ultimately leads to our making psychological errors. Well, thank you so much for watching. If you enjoyed today's video, please give it a thumbs up and subscribe our channel for more content like this.